What if I told you that you already have an enormous advantage over professional Wall Street investors, and you don't even realize it? What if the reason most people lose money in stocks isn't because they don't know enough, but because they're ignoring what they already know from their everyday life? In the next 20 minutes, you're about to discover why legendary investor Peter Lynch believes ordinary people can beat the professionals, how to find winning stocks in your daily life, and the exact investment principles that turned him into one of the most successful fund managers in history. This is One Up on Wall Street, and it might completely change how you think about investing. Let's begin. One Up on Wall Street by Peter Lynch is one of the most influential investing books ever written. Lynch managed the Fidelity Magellan Fund from 1977 to 1990, turning it from an $18 million fund into a $14 billion behemoth with average annual returns of 29%, beating the market and almost every other fund manager for over a decade. His secret wasn't sophisticated Wall Street analysis or insider information. It was paying attention to everyday life and investing in what he understood. Lynch's revolutionary insight is that individual investors have advantages over professionals that they consistently fail to use. You notice that everyone at your office is suddenly drinking Starbucks coffee years before it's on Wall Street's radar. You see your teenage daughter and all her friends obsessed with a new retailer before analysts cover it. You work in an industry and know which companies are thriving before quarterly reports prove it. This is your edge. You see things first in real life before Wall Street sees them in spreadsheets. The problem is, most amateur investors ignore their advantages and try to beat Wall Street at Wall Street's game, analyzing complex financial statements, timing the market, and chasing hot tips from experts. Meanwhile, they overlook the obvious winners right in front of them. Lynch's message is simple. Stop trying to be a professional investor and start being an informed consumer who notices which products and companies are succeeding. Then invest accordingly. This book provides a complete framework for individual investors. Lynch explains how to find investment ideas in everyday life, what types of companies make the best investments, how to analyze companies simply without being a financial expert, when to buy and sell, how to build a portfolio, and how to avoid the psychological traps that destroy returns. His approach is remarkably accessible. You don't need an MBA or complex software. You need curiosity, common sense, and willingness to do basic homework. We'll explore 8 core concepts: understanding your edge as an individual investor, finding stocks in everyday life, the 6 categories of stocks and which to focus on, Lynch's fundamental analysis approach, when to buy and when to sell, portfolio management principles, avoiding common mistakes, and developing the right investing temperament. Each concept is practical and immediately applicable, drawing from Lynch's own investment successes and failures. Chapter 1: Your Edge Over Wall Street. Lynch's most radical message is that individual investors have enormous advantages over professional money managers, advantages that outweigh the professional's superior resources, experience, and information. Understanding these advantages is the foundation of his entire investment philosophy. The first advantage is flexibility. Professional fund managers face enormous constraints. They manage so much money, they can only invest in large companies because small ones don't have enough liquidity to absorb their positions. They face pressure for quarterly performance, preventing long-term thinking. They're restricted by fund mandates and compliance rules. They must explain every decision to bosses and clients. Individual investors face none of these constraints. You can invest in any size company, hold as long as you want, and answer only to yourself. Lynch explains that this flexibility is incredibly valuable. Many of his best investments were small companies that grew into large ones. Dunkin' Donuts, Stop and Shop, Taco Bell. When it was tiny, these companies multiplied in value but were too small for most professional managers to bother with. As an individual investor, you can find these companies early when they're still small enough to multiply rapidly. Invest your entire portfolio if convinced, and hold through temporary setbacks that would force a professional to sell. The second advantage is knowledge from everyday life. You see consumer trends before Wall Street does. You know which restaurants are packed and which are empty. You notice which products your coworkers are buying. You hear which companies are expanding in your industry. You experience which retailers have great service and selection. This real-world information is more valuable than any Wall Street report because it's current, direct, and reflects actual customer behavior rather than analyst speculation. Lynch shares how he discovered Legs Pantyhose, Dunkin' Donuts, and numerous other winners through everyday observation. He noticed his wife and her friends raving about certain products. He saw retail stores packed with customers. He talked to industry contacts who mentioned thriving companies. These weren't sophisticated research techniques. They were just paying attention to the world around him and connecting observations to investment ideas. The third advantage is no career risk. Professional fund managers face career-ending consequences for being different and wrong. If they own unconventional stocks that fail, they're fired. But if they own the same stocks everyone else owns and fail, they're safe because everyone else failed too. This creates herd mentality where professionals avoid standing out. Individual investors face no such career risk. You can invest in unpopular stocks without worrying about getting fired. If you're right, you profit. If you're wrong, you learn something, but nobody fires you. This career safety allows contrarian thinking. Some of Lynch's best investments were companies Wall Street hated or ignored. When everyone thought retail was dying, he found thriving retailers. When analysts dismissed boring industrial companies, he found steady growers. Individual investors can buy what's unloved and wait for recognition without career pressure forcing premature selling. The fourth advantage is ability to wait. Professional managers face constant pressure for performance. If they lag the market for 2 quarters, investors withdraw money and they face career consequences. Individual investors can wait years for an investment thesis to play out. If you find a great company trading cheaply, you can hold through temporary setbacks, market crashes, and periods where it's out of favor. Your patience is a massive competitive advantage in a world where professionals are forced to focus on next quarter. Lynch emphasizes that these advantages only matter if you use them. Most individual investors squander their edge by trying to act like professionals, buying large, well-known stocks, checking prices constantly, trading frequently, and following Wall Street research. Instead, you should invest in companies you discover through everyday observation. Smaller companies professionals ignore, unpopular stocks you understand and hold for years. This is how you beat Wall Street at a game they can't play. Chapter 2. Finding Stocks in Everyday Life. Lynch's most famous advice is to invest in what you know, but he's not suggesting you invest in your employer or randomly buy consumer products you like. He's teaching a systematic approach to finding investment ideas through observation of everyday life, then researching whether those ideas represent good investments. The process starts with noticing. As you go through your day, pay attention to products, services, and companies that seem to be thriving. Which stores have parking lots full of cars? Which restaurants have lines out the door? Which products are your friends and coworkers buying repeatedly? Which companies in your industry are winning business? These observations are research. They tell you what's working in the real economy before financial statements confirm it. Lynch calls this shopping for stocks. You're literally walking through stores, malls, and daily life looking for companies that seem to be doing well. This isn't a guarantee of good investment. It's a source of ideas to research further. The packed parking lot tells you to investigate that retailer. Your teenager's obsession with a brand tells you to research that company. The product you love tells you to learn about the business behind it. He shares numerous examples from his own career. He discovered Dunkin' Donuts because their stores were always packed. He found Taco Bell by noticing lines at their locations. He invested in Hanes because his wife raved about legs pantyhose. He bought retailers by observing customer traffic and talking to store managers. None of these ideas came from Wall Street research. They came from paying attention to everyday life. The key is asking the right questions when you notice something interesting. If a store is packed, ask, why are customers choosing this retailer over alternatives? What's their competitive advantage? Better prices, selection, location, or service? How fast are they expanding? Could they expand much further? Is this a temporary fad or sustainable success? Could they repeat this success in other markets? These questions guide your research. Lynch emphasizes different sources of stock ideas. Your workplace is one of the best sources. You know which suppliers and customers are thriving, which competitors are winning or losing, and which industry trends are developing. Your kids are another great source for spotting consumer trends early. Your hobbies and interests give you expertise about companies serving those markets. Your daily experiences as a consumer reveal which companies are executing well. Regional advantages matter too. If you live in a city where a regional company is thriving, a bank, retailer, or restaurant chain expanding successfully, you'll notice it years before national investors do. By the time Wall Street covers a regional success story, it might have tripled from when local investors could have bought it. Lynch made fortunes investing in regional banks and retailers that locals could have bought years earlier. He warns against certain types of story stocks that sound great but usually fail. Companies in hot sectors everyone's talking about, whatever the trendy technology or business model of the moment is, usually disappoint because expectations are too high and too many competitors enter. Companies with products that sound exciting but aren't actually being used or bought yet. Revolutionary technologies, cures, or inventions that are always just around the corner rarely work out. Invest in what's working now, not what might work someday. The practical application is making observation a habit. Wherever you go, notice what's thriving. Talk to people in your network about their industries. Read trade publications for sectors you understand. Visit stores and restaurants to see customer traffic. Follow up on things your kids are excited about. Create a list of companies that seem interesting based on real-world observation. Then, and this is critical, do the research to see if they're actually good investments before buying. Chapter 3. 6 Categories of Stocks. Not all stocks are equal. Lynch categorizes stocks into 6 types, each with different characteristics, growth potential, and appropriate investment strategies. Understanding these categories helps you know what you own, what to expect, and how to evaluate whether the investment is working. Slow growers are large, mature companies growing slightly faster than the economy. Think major utilities, railroads, or huge established manufacturers. These companies offer modest growth, reasonable dividends, and relative safety. Lynch generally avoided slow growers because their upside is limited. If they're growing 2% annually, the stock won't multiply rapidly. However, they're appropriate for conservative investors who want steady dividends and capital preservation over growth. Stalwarts are large, well-known companies growing 10 to 12% annually. Think Coca-Cola, Procter & Gamble, or major retailers during good times. These companies are solid holdings that won't multiply tenfold, but can double or triple over several years, while providing downside protection during market downturns. Lynch typically held stalwarts as core portfolio holdings, expecting 30-50% gains over a few years, then often selling to redeploy in faster growers. Fast growers are smaller companies growing 20-25% annually. These are the big winners, companies that can multiply 10x or more over several years if growth continues. Lynch loved fast growers because this is where fortunes are made. However, fast growers are risky. High growth attracts competition. Expansion can overwhelm management. And when growth slows, the stock often collapses. The key is finding fast growers early before they're well known, and selling before growth inevitably slows. Cyclicals are companies whose earnings rise and fall dramatically with economic cycles. Auto manufacturers, airlines, steel companies, chemical manufacturers. Lynch warns that cyclicals are the most misunderstood stocks. People buy them when times are good, earnings are high, and P/E ratios look low, not realizing that's the worst time to buy because the cycle is about to turn down. The time to buy cyclicals is when times are terrible, earnings have collapsed, and the stock seems expensive based on depressed earnings because the cycle is about to turn up. Turnarounds are troubled companies trying to recover from near bankruptcy or severe problems. When successful, turnarounds can multiply several times because the stock usually bottoms at extremely low prices, reflecting low survival expectations. But turnarounds are risky. Many don't recover and go bankrupt. Lynch liked turnarounds with no debt because they can't go bankrupt without debt. He looked for signs the turnaround was working: new management, improving operations, cost-cutting, or business restructuring, before the market recognized recovery. Asset plays are companies with valuable assets the market hasn't recognized. Real estate worth more than book value, resources like oil or minerals, subsidiaries that could be sold for more than the current stock price reflects. Lynch invested in asset plays when he could buy companies for less than their liquidation value, knowing they had a floor protecting downside. Asset plays often stay cheap for years, then suddenly get recognized through takeovers, asset sales, or management changes that unlock value. Understanding these categories helps set realistic expectations. If you buy fast growers, expect volatility but potential multi-bagger returns. If you buy stalwarts, expect steady, modest gains. If you buy cyclicals, understand you're betting on timing the cycle. Don't expect slow grower returns from fast growers, or vice versa. Match your expectations to the category. Lynch emphasizes that the best portfolios contain several categories, not just one. He typically held fast growers for maximum upside, stalwarts for steady performance, and occasionally cyclicals or turnarounds when opportunities arose. Diversification across categories provides both growth potential and downside protection. During market downturns, stalwarts and asset plays hold up better than fast growers. During bull markets, fast growers provide the big gains. The practical application is categorizing every stock you own or consider. Don't just know the company name. Know what category it fits, and therefore what returns to expect and how to evaluate whether it's performing as expected. If your fast grower is only growing 10% annually, it's not really a fast grower. Maybe it's become a stalwart, and you should adjust expectations or sell. If your cyclical is booming, but everyone's optimistic, that's a sell signal, not a hold signal. Chapter 4. Lynch's Fundamental Analysis. Lynch made investing accessible by showing you don't need sophisticated analysis. Just answer a few key questions about any potential investment. His fundamental analysis focuses on the simple factors that actually predict success, not elaborate financial modeling. The first question is whether the company is in a boring industry. Lynch actually preferred boring businesses, waste management, bottling, manufacturing mundane products. Why? Because boring industries have less competition. Exciting businesses attract competitors and investor attention, inflating prices and reducing returns. Boring businesses are ignored, often cheap, and can compound quietly for years. Some of Lynch's best investments were companies doing mundane things excellently. The second question is whether the company does something disagreeable. Companies in unpleasant businesses, funeral homes, pest control, hazardous waste, face minimal competition because most people don't want to enter those industries. This lack of competition allows excellent economics and steady growth. Don't avoid companies because their business is unpleasant. That unpleasantness is actually an advantage, creating competitive moats. The third question is whether institutions own very little of the stock. Lynch wanted to own stocks before institutions discovered them because institutional buying drives prices up. If a small company has low institutional ownership, it's off Wall Street's radar, likely undervalued, and offers massive upside when institutions eventually discover it. Check institutional ownership in stock data. If it's under 10-20%, you're early. If it's over 50-60%, you might be late. The fourth question is whether insiders are buying. When management and board members are buying stock with their own money, it's one of the most bullish signals possible. They know the business intimately and wouldn't buy if prospects were poor. Lynch always checked insider buying and considered it a strong positive sign. Conversely, heavy insider selling is concerning, though less so, because insiders sell for many reasons, while they only buy because they think the stock will rise. The fifth question is about the company's growth rate versus P/E ratio. Lynch used the PEG ratio, P/E divided by growth rate, as a quick valuation check. A PEG under 1.0 suggests undervaluation, while a PEG over 2.0 suggests overvaluation. For example, a company growing 20% annually with a P/E of 15 has a PEG of 0.75, likely undervalued. A company growing 10% with a P/E of 30 has a PEG of 3.0, likely overvalued. This isn't perfect, but provides quick guidance. The sixth question is about the balance sheet, specifically debt levels. Lynch strongly preferred companies with little or no debt because they can't go bankrupt without debt. High-debt companies face constant bankruptcy risk if business turns down or interest rates rise. Check the balance sheet and prefer debt-to-equity ratios under 0.5 for most companies, under 0.3 for cyclicals. No-debt companies can weather any storm. The seventh question is about cash generation. Does the company generate free cash flow, actual cash coming in beyond what's needed to maintain the business? Cash flow is harder to manipulate than earnings and indicates real economic value. Companies that generate increase in free cash flow year after year are likely good businesses. Companies with negative or declining cash flow, despite reported profits, are concerning. Lynch emphasizes the importance of the company's story. Can you explain in 2 minutes or less what the company does, why it will succeed, and what could go wrong? If you can't articulate the investment thesis simply, you don't understand it well enough to invest. The best investments have simple stories. They're a retailer expanding from 100 to 1,000 stores with a proven format. They dominate a niche manufacturing business growing with GDP. They're turning around by cutting costs and refocusing on core business. Complex stories usually indicate complex businesses you should avoid. Finally, Lynch wanted to know what could go wrong. Every investment has risks. What are they for this company? Competition, technological change, economic sensitivity, regulatory risk, management execution, expansion challenges. Knowing the risks doesn't mean avoiding the investment. It means understanding what to monitor and being prepared mentally if things go wrong. Many investors ignore risks, then panic when predictable problems occur. The practical application is creating a simple checklist for every potential investment. Write down, what category is this stock? What's the simple story? What's the competitive advantage? What are growth prospects? What's the PEG ratio? What's the debt level? Are insiders buying? What are the main risks? If you can't answer these questions satisfactorily, don't invest. This simple analysis prevents most bad investments while identifying the good ones. Chapter 5. When to buy and when to sell. Knowing what to buy isn't enough. You must know when to buy, how much to buy, when to sell, and how to handle the psychological challenges of both buying and selling. Lynch provides practical guidance on timing decisions without attempting to time the market. Lynch's philosophy on when to buy is simple. Buy when you've found a good company at a reasonable price, regardless of market conditions. Waiting for market corrections, trying to buy at absolute bottoms, or waiting for clarity means missing opportunities. If you've done your homework and found a fast grower with a PEG of 0.7, buy it now. If it drops 20%, buy more. But don't wait for perfect conditions that never arrive. He emphasizes that you never know everything before buying. There's always uncertainty, always potential bad news, always reasons to wait. Perfect information is impossible, but if your analysis suggests the stock is significantly undervalued relative to prospects, buy some now. You can always add more later if your thesis proves correct and you gain more confidence. Starting with a smaller position allows you to increase if you're right, while limiting damage if you're wrong. Position sizing depends on conviction and risk. Lynch sometimes invested 5 to 10% of his fund in his highest conviction ideas while maintaining 1 to 2% positions in more speculative or uncertain situations. As individual investors with smaller portfolios, you might make your best ideas 10 to 15% positions and lesser ideas 3 to 5% positions. The key is not having so many stocks that you can't follow them, but having enough diversification that no single failure destroys you. When to sell is harder than when to buy. Lynch identifies several sell signals for different stock categories. For slow growers, sell when they stop growing or cut their dividend. For stalwarts, sell when they've appreciated 30-50% as expected, growth is slowing, or they're becoming overvalued. For fast growers, the hardest, sell when growth slows to stalwart levels, PE becomes unjustifiably high, or competition has intensified dramatically. For cyclicals, sell when times are great, everyone's bullish, and expansion is peaking. For turnarounds, sell when the turnaround is complete and widely recognized. Lynch created the 5-year rule for fast growers. If a company is growing rapidly and you expect 5 more years of strong growth, hold regardless of price fluctuations. But every year, reassess. Do they still have 5 years of growth ahead? When the answer becomes maybe 2 years, sell. This forces you to focus on fundamentals, remaining growth potential, rather than price movements. He strongly advises against selling winners too soon, which he calls pulling the flowers and watering the weeds. Most investors sell winners after small gains to lock in profits, while holding losers, hoping they'll recover. This guarantees mediocre returns. You're cutting gains short and letting losses run. Lynch advocates the opposite. Sell your losers when the thesis proves wrong, and hold winners as long as the growth story remains intact. Many of his biggest gains came from holding winners for years after they'd already doubled or tripled. The story is the key to hold or sell decisions. Revisit your original investment thesis regularly. Is it still valid? If you bought because the company was expanding from 100 to 500 stores and they've now reached 450 stores, with expansion slowing, the story is nearly complete. Time to sell. If you bought expecting a turnaround and the turnaround has succeeded, sell. If you bought a fast grower and growth is accelerating beyond expectations, hold, even if the stock has tripled. Lynch also discusses selling for portfolio management reasons. If a stock has grown to become 25% of your portfolio, you might trim it to reduce concentration risk, even if the story remains strong. If you find a much better opportunity, you might sell a less compelling holding to free up capital. If you need cash for life expenses, sell your weakest positions or trim your largest, but don't sell your best holdings because you need money. The emotional challenge of selling is real. Selling winners creates regret if they keep rising. Selling losers means admitting you were wrong. Lynch's answer is to focus on whether the stock will perform well going forward, not whether you'll feel bad about the decision in retrospect. You can't know the future, so make the best decision based on current information. If the growth story is intact, hold. If it's not, sell. Don't let ego, regret, or emotional attachment override logic. Chapter 6. Portfolio Management. Building and managing a portfolio requires balancing diversification, concentration, different stock types, and regular monitoring without overtrading. Lynch shares how he managed Magellan and how individual investors should approach portfolio construction. On diversification, Lynch's view is nuanced. He held hundreds of stocks in Magellan, but individual investors shouldn't copy this. He was managing billions and required that many positions to deploy capital. For individual investors, Lynch suggests 5 to 10 stocks minimum to avoid catastrophic concentration risk, but no more than 20-25 stocks maximum, because tracking more becomes impossible for non-professionals. The optimal number depends on your time and interest. If you're passionate about investing and willing to spend hours weekly researching, you can handle 15-20 stocks. If investing isn't your main focus, hold 5-10 stocks you truly understand. Never own more stocks than you can monitor adequately. The person with 40 stocks they barely know is worse off than someone with 7 stocks they understand deeply. Portfolio should contain mix of categories. Lynch typically held mostly fast growers for upside potential, some stalwarts for stability, and selective cyclicals or turnarounds for additional opportunities. Individual investors might similarly allocate 50-60% in fast growers, 30-40% in stalwarts, and 10-20% in opportunistic special situations. The exact mix depends on your age, risk tolerance, and investment goals. He strongly advocates against over-diversifying. The person who owns 50 stocks guarantees average returns because they're essentially buying the market. The whole point of stock picking is to beat the market by concentrating in your best ideas. If your 10th best idea isn't compelling, don't buy a 15th stock just for diversification. Hold more of your top ideas or keep cash for future opportunities. Lynch's rebalancing approach differs from standard advice. He didn't automatically sell winners to rebalance. Doing so means selling your best performers. Instead, he let winners run while adding to losers only if the thesis remained valid. However, if a winner grew to dominate the portfolio, 30% plus of assets, he would trim partially to reduce risk while keeping significant exposure if the story remained strong. Regular monitoring is essential. Lynch reviewed every holding quarterly when financial results were released. He asked, "Are results meeting, beating, or missing expectations? Is the growth story intact? Has anything fundamentally changed? Have new risks emerged?" This quarterly review keeps you informed without encouraging overtrading based on daily price movements. The concept of buying what you know extends to portfolio management. You should understand every holding, what the company does, why you own it, what would make you sell. If you can't remember why you own something, you probably shouldn't own it. This understanding allows you to hold through volatility without panic because you're confident in the underlying business, not just reacting to price changes. Lynch discusses the importance of keeping good records. Track your purchase price, your original thesis, when you bought and why. Review these notes annually to assess whether your original reasons for buying still apply. This disciplined review prevents holding stocks out of inertia after the original thesis has broken down. He also addresses the psychological challenge of diversification. It's painful when a stock you don't own rises dramatically while your holdings stagnate. But you can't own everything, and chasing what's already risen usually leads to buying high. Focus on your own holdings and whether they're performing as expected for their category. A stalwart returning 12% annually is succeeding even if some other stock rose 50%. You can't and shouldn't own every winner. Finally, Lynch emphasizes that portfolio management is ongoing. Markets change, companies change, your financial situation changes. Annually review your entire portfolio. Do these holdings still align with your goals? Are you over-concentrated in one sector? Are you holding too many similar companies? Have some holdings grown so much they dominate the portfolio? Regular comprehensive review prevents drift and keeps your portfolio aligned with your strategy. Chapter 7. Avoiding Common Mistakes. Lynch dedicates substantial attention to the psychological and behavioral mistakes that destroy investment returns. Avoiding these mistakes matters more than finding great stocks, because mistakes wipe out gains from your winners. The first major mistake is confusing a good company with a good stock. A wonderful company with a great product and excellent management can be a terrible investment if you overpay. The stock price must reflect realistic expectations for growth, not perfection. Many investors bought Xerox, Polaroid, or other great companies at sky-high prices and lost money when growth didn't justify valuations. Always ask, even if this is a great company, am I paying a reasonable price? The second mistake is worrying about what you paid. Lynch emphasizes that the market doesn't care what you paid for a stock. If you bought at $30 and it's now $20, the relevant question isn't, how do I get back to $30? But, is this worth $20 based on fundamentals? If yes, hold or buy more. If no, sell. Hoping to get even before selling is emotional nonsense that keeps you in bad investments while potentially missing better opportunities. The third mistake is trying to time the market or predict macroeconomic events. Lynch never attempted to time market tops or bottoms, predict recessions, or guess interest rate moves. He focused on finding good companies regardless of market conditions. His data showed that missing just the 40 best days over multiple decades reduced returns by more than half. Since nobody can predict which days will be best, trying to time the market almost guarantees underperformance. The fourth mistake is believing hot tips, stories, or can't-miss opportunities. Lynch learned early that hot tips usually don't work. By the time a tip reaches you, everyone else knows it, and it's priced in. The bartender's stock tip, your neighbor's recommendation, or the exciting story from a party, these feel like special information, but are usually late to a story that's already run. Do your own research instead of relying on second-hand excitement. The fifth mistake is over-diversifying. Lynch repeats this because it's so common. Investors who own 30, 40 stocks they barely know are setting themselves up for average returns at best. They're too diversified to benefit when they're right, but still exposed when they're wrong. Better to own fewer stocks you understand deeply, allowing your best ideas to meaningfully impact returns. The sixth mistake is confusing effort with results. Checking stock prices daily, reading constantly about markets, watching financial television, these activities feel productive but rarely improve returns. Lynch checked prices quarterly, focused research on understanding businesses, and ignored market noise. The investor who checks prices once a quarter often outperforms the one checking hourly because they're not tempted to make emotional trades based on short-term movements. The seventh mistake is selling winners too soon. Lynch saw this constantly. Investors selling stocks after 20-30% gains to lock in profits while holding losers. This guarantees mediocrity by cutting winners short. Some of Lynch's stocks rose 1,000% plus because he held through multiple doublings. If the growth story remains intact and valuation is reasonable, hold regardless of how much the stock has already risen. The eighth mistake is averaging down on losers without reassessing the thesis. Catching a falling knife destroys portfolios. When a stock falls, don't automatically buy more. First, understand why it's falling. If fundamentals have deteriorated, falling prices reflect reality, and buying more compounds the error. Only average down if you've reassessed the thesis and are more convinced than originally. Lower prices don't automatically mean better value if the business is deteriorating. Lynch also warns against letting taxes dominate investment decisions. Don't hold a stock you should sell just to avoid capital gains taxes. The tax on a gain is vastly better than the tax of watching a stock fall because you refuse to sell. Taxes are a cost of success. Pay them and move on to better opportunities. The concept of rear-view mirror investing is another major mistake. Investors frequently buy last year's winners assuming they'll keep winning, or avoid last year's losers assuming they'll keep losing. But investment success requires buying what will do well going forward, not what did well previously. Yesterday's winners often become tomorrow's disappointments when growth slows, while yesterday's disappointing sectors sometimes produce tomorrow's best returns when nobody expects it. Finally, Lynch warns against letting ego drive decisions. Admitting you were wrong about an investment is painful, but holding a losing investment to avoid admitting error is far more painful financially. Nobody's right all the time. Lynch freely admitted his mistakes and moved on quickly. The ability to admit you were wrong and sell losers before they become catastrophic losses is essential to long-term success. Chapter 8. Developing the right temperament. Knowledge and analysis matter, but investment success ultimately depends on temperament. Your ability to think independently, handle volatility emotionally, maintain discipline, and persist over decades. Lynch discusses the psychological qualities that separate successful investors from unsuccessful ones. The first essential quality is patience. Fast growers take years to multiply in value. Turnarounds take time to recover. Even obvious opportunities don't immediately generate returns. Lynch held stocks for 5 to 10 years routinely, knowing that his investment theses required time to play out. Impatient investors sell too soon, missing the bulk of returns that come late in a stock's appreciation. Cultivate multi-year thinking, not quarterly or monthly. The second quality is independence, the ability to think differently from the crowd and act on your convictions despite what others think is essential. Lynch bought retailers when retail was hated, cyclicals when everyone was pessimistic, and small boring companies nobody discussed. His best returns came from contrarian positions. If you need validation from others before investing, you'll always be late to opportunities and early to exits. The third quality is emotional stability during market volatility. Markets crash regularly 20 to 30% declines happen every few years. 50% plus declines happen occasionally. If you panic and sell during these declines, you lock in losses and miss the recovery. Lynch stayed fully invested through every crash during his tenure, continuing to buy stocks he believed in. His ability to remain calm when others panicked was crucial to his success. Lynch shares the important distinction between risk and volatility. Risk is permanent loss of capital, investing in a business that goes bankrupt. Volatility is temporary price fluctuation, your stock falling 30%, then recovering. Many investors confuse the two, seeing volatility as risk and selling during downturns. Understanding the difference allows you to ignore volatility while focusing on avoiding permanent loss through proper analysis and diversification. The fourth quality is discipline to follow your process regardless of market conditions. When stocks are rising and everyone's making money, it's tempting to abandon careful analysis and buy anything. When markets are crashing and everyone's losing money, it's tempting to give up and sell everything. Successful investing requires doing the same thing regardless of mood, analyzing businesses, buying undervalued stocks, holding winners, and selling losers when the thesis breaks. The fifth quality is continuous learning. Lynch read constantly, annual reports, industry publications, newspapers, anything that might generate investment ideas or insights. He talked to people in various industries. He visited stores and factories. He never stopped learning about businesses and markets. The investor who stops learning stops finding new opportunities and stops improving their analysis. Lynch emphasizes that optimism is essential. If you're pessimistic about the future, you shouldn't invest in stocks. You're betting on capitalism and progress, which require optimism. There's always something to worry about. Recession fears, political uncertainty, international crises. But over time, businesses adapt, innovate, and grow. The economy expands more years than it contracts. Earnings rise over decades. Betting on long-term progress has worked for over a century and likely will continue. The concept of staying in the game is crucial. Lynch's returns weren't from never being wrong. He had plenty of losers. His returns came from being in the market consistently, always having capital deployed in stocks he believed in, and letting his winners compound over time. The person who sold everything in 1987, fearing a crash, missed the entire bull market of the 1990s. Staying invested means you're automatically there for the best days, which drive long-term returns